Unraveling the mystery of the inverse relationship between bond prices and interest rates. That's what I want to cover in this video. This is video number 50 on this channel, and today is the 12th of March 2025. So you've probably heard of this saying that when interest rates fall, bond prices rise. Sometimes it's put in the other way around. When interest rates rise, bond prices fall. So there's an inverse relationship between interest rates and bond prices. So why is this so? What is exactly happening here? That's what I want to briefly share in this short video. So let's go. We'll first start by just reminding ourselves on the basics of bonds. So when you buy a bond, what you are essentially doing is lending money to a government or to a corporation. Okay, so it's a loan that you are giving to a company or to a government. And because it's a loan, the government or a corporation, they promise to pay you back your money with interest. Okay, so the interest is called a coupon, and it is paid over the period of that loan. So as an example, for example, when you buy a 10-year bond, and let's say the coupon interest is 25%, it means you have and the bond, let's say it's for 100,000 kwacha. It means you have lent the government or a corporation 100,000 kwacha, and that loan is for a period of 10 years, and they have promised that every year they will pay you 25% interest. Now for a bond, the way this interest is paid, it's paid every 6 months. So it means every 6 months you will get your 12,500 kwacha for a period of 10 years, and then at the end of the 10 years you get your 100,000 kwacha back. So this agreement remains fixed, whether irrespective of what happens with interest rates. For as long as you go full term, you can expect that every 6 months you'll be getting your 12,500 kwacha for 10 years, and then at the end of the 10 years you'll be able to get your 100,000 kwacha back. So this part is fixed. So now what does it mean when we say that the value of the bond will change depending on the interest rates? When in one breath we are saying your coupon rates and the money that you get at the end of the bond is fixed. So this is where the key distinction is. So you need to look at fixed payments and market price. So what we are saying is that the fixed payments, if your bond will last the full term, your fixed payment will remain fixed. But that does not say anything about the market price. So your fixed payments that you receive are very different from the bond's market price. Okay, so you will get your exact coupon payments and your principal at maturity, but the bond, what you also need to know is that bonds are traded on the secondary market, just like the way stocks are traded. So in Zambia, the primary market for bonds is the Bank of Zambia, but the secondary market for bonds is the Lusaka Securities Exchange. Okay, so what it means is that the prices of bonds can change before they mature, and these changes are influenced by interest rates. So how does that happen? So let's say Bank of Zambia issues a bond, a 10-year bond, and the interest rate for that bond is 25%. Okay, and this is in January. They issue a bond, um, a 10-year bond, and the interest rate is 25%. You buy that bond, okay, and you begin to get your 25% coupon every year, meaning that every 6 months you begin to get your 12.5% interest coupon for that bond. You buy that bond, okay, and since bonds are issued um, like monthly, let's assume the following month or 2 months after that or 6 months after that, there is another bond that Bank of Zambia issue. And for this bond, it's also a 10-year bond, but the interest rate has dropped. Instead of the interest rate being 25% like the other bond, this new bond has an interest rate of 10%. Okay, so people will go to the primary market, um, and they will buy that second uh, uh, bond. So what that means is that we have two sets of 10-year bonds in that short period of time. Okay, the first bond that you bought at 25%, and there's another bond now that is being sold by Bank of Zambia at 10%. So what that means is that your existing bond, your bond that you bought at 25%, with its higher coupon becomes more attractive than the new 10-year bond that Bank of Zambia has issued. So remember, you have that 25-year bond, a 25% bond. You can trade it on the secondary market because it has a higher yield of 25%. So for investors that want to buy 10-year bonds, they would rather come to you who has a bond or that yields 25% than go to Bank of Zambia to buy a bond that yields at 10%. This is the most critical point that you need to get from this. Okay, and you can think it this way. Let's say you have a product that pays you 25%, and there's a new product that comes on the market and can only pay you 10%. Clearly you can see that the product that pays 25% becomes more attractive than the product that pays 10%. So the value of your existing bond has become more valuable, has become higher on the secondary market than the new bond that can only pay 10%. Okay, so really that's what this is all about. If you get a bond and you want to go full term without selling it on the secondary market, the payments that you get are fixed, but the value of that bond on the secondary market, should you wish to sell it, will be fluctuating based on the interest rates. So when the interest rates fall, existing bonds with higher coupons become more attractive. Okay, so that is what this relationship is about. It is with respect to the value of your bond on the secondary market. I hope this helps, because I think as you understand this, you'll be able to make better informed decisions with your investments, whether or not you would want to sell your bond um, on the secondary market. Okay, I hope you found this helpful. I would want to hear your comments, questions, if at all you found this very helpful. Thank you.